Welcome back, folks. John Grace, President, Investors Advantage, and I just want you to know the Money Doctor is in. We look at things in a couple of ways. One, we've been talking about what needs to happen so that the money runs out after you do. In other words, you don't want to run out of money before you run out of time. And we'll be talking more about that. But now we want to look at the other scenario, because there are really only two things that are going to happen to us. Either we're going to live too long, run out of money before we run out of time, or we're going to die too soon. And, you know, it's always premature. But the question becomes, financially, how can we make it a non-event? How can we make it so that it isn't painful, it isn't uncomfortable, that the money still flows for those of us who are here? That's what we'll be addressing today. John Grace, Investors Advantage, we're looking at a case study in terms of life insurance. And as I say, I apologize for the people who are in the securities business. I've been securities licensed since 1979 because we tend to ask bad questions. I also apologize for the people in the insurance business. I've been licensed in insurance since 1979 because we ask bad questions. We ask questions like, what can you afford in the way of insurance? What's your budget? I think that's the wrong question. Imagine going to your State Farm agent, whoever your car and casualty insurance might be with, and saying, I'm driving a whatever I'm driving, and I only want to pay $50 a month for you to insure my car. It doesn't work that way. Based on your driving history and the zip code and the car that you're driving, that's how the cost gets worked out so that you're not self-insured to replace this car in the event it gets totaled. When we look at having enough life insurance, the question becomes, what kind of income are we trying to protect? And my point here is that in many cases we've got people who are interdependent upon each other's income. So if there's a lost income because of death, the survivors still are accustomed to that level of income. Nicole Davis came to us, a good client of ours, and in fact her family have been clients for a long time. 39 years old, she's a brand new mom, she's due in July. Doesn't look like she's going to marry the professional athlete father. And the question becomes, I have $5,000 a month that I'll be receiving from the father of the child, and in the event he doesn't come home, what do I need to keep things going? Very good question. We suggest that everyone ask questions like that, because then you know what you're dealing with as opposed to hoping. Hope is not a strategy. So when we ask the question, we look at it from the standpoint of how much money are we going to need to put away in the event he dies, so that there's $60,000 a year coming in or $5,000 a month, and the answer is $1.5 million. A 4% withdrawal on that would be $60,000 a year or $5,000 a month. No drama in the event Dad does not come home. What we're suggesting is that you do the same thing, that you look at yourselves, your situation, and ask the question, in the event my spouse doesn't come home, my partner doesn't come home, in the event that there's an income that stops and I'm the survivor, how much do I need to keep things going? Vice versa for the other survivor. What often happens, men in particular will say, well, I have $500,000 worth of life insurance. I'm worth more dead than alive. Well, let's say I make $100,000 and I have $500,000 worth of life insurance. Here's the deal. Either my survivors are going to have to live off of the principal, which means $100,000 a year, that's about 5 years, or they're going to have to get by on using the interest. 4% withdrawal on $500,000 is what, $20,000 a year? Was that $1,650 a month, somewhere in that neighborhood? Not too much. Certainly not what I was making, $8,000 a month. Very big difference. So to keep things going, I would need to have far more coverage than $500,000. But if I don't know what that is, it seems like I'm fine, and frankly, I'm not. My prescription for you as the Money Doctor is to look at two things. If we live to be 100 and we want to make work optional at age 65, whatever it might be, that's a question. How much are we going to need? How might we get from here to there so that we can make work optional, live to be 100, and not run out of money before we run out of time? The other part of the equation is if we die too soon. How much money is the survivor going to need to keep things going? Those would be my prescriptions for you at this particular time. The Money Doctor is out.